Listen, Fannie Mae may have just shook up the credit industry for good. Listen close. This could benefit you, but I want you to be aware of the side pieces that go along with it that may have a negative impact on you if you're not careful. Just because everything looks as though it can be to your benefit doesn't mean that it is on the back end. So be very mindful. So what do I mean? Fannie Mae scraps the minimum credit score for DU loans. And I'll let you know what DU means. But basically, they're saying the credit score doesn't matter. Now, this is big because we've always preached making sure you take a holistic approach to your credit because your profile matters more than your score. Without the profile, without the report, the score doesn't exist in the first place. So don't get caught off guard thinking, oh, the score doesn't matter. I can just have any kind of situation going on, 400 credit score, and I can get approved. That's not what this is. But it's important to understand the nuances of it so you can know how to move going forward if you're interested in buying a home. And share this with somebody who you feel may benefit because this is major because a lot of people have been scared to apply for things based on just the score alone. But applying for a profile or a home is much more than just the score anyway. I got a client who's also a friend of mine where I was telling them, look, your score is one thing, but we're looking at your whole overall profile, your debt to income ratio, and all of those things. And now we can position you to get a home because your work history is solid and things of that nature that can position you to get a home and you'll be the perfect candidate for a home. And this was before this rule was on the verge of being applied, which is effective November the 16th, depending on when you're watching this video. This day has not approached just yet, but Fannie Mae has announced it would eliminate the 620 minimum credit score requirement for loans processed through its desktop underwriter. That's the DU system. And it sounds like it may be some type of AI that does some screening, and minimizes or eliminates jobs of what people would have done as an underwriter. And this is effective November 16th. 2025. The change detailed in the latest DU version 12.0 release notes and selling guide update represents a major shift in mortgage eligibility and could help more borrowers with lower credit scores but solid finances qualify for loans. Underline solid finances. Why is that important? Because some people are going to look at it like, oh, credit score don't matter, and they just go in there and apply. No. Solid finances mean that they can look at your profile and tell that you're somebody who they feel is likely to pay them back based on your history. They can look and tell what your debt to income ratio is and determine whether or not a mortgage is something you may default on based on other agreements that you may have. They can also look and tell whether or not you've been working for a certain amount of time or generating a certain amount of income based on the documents that they will require. And they'll say, okay, this person has a level of stability. We can trust them with the mortgage. So they're still going to protect their bottom line, not just approve anybody just because the credit score has been lowered. Very important. Because some people may spin this and make it seem like, it doesn't matter, anybody can get approved, which a lot of that may take place, but it's going to be more so based on the factors I laid out, which is also why we take a holistic approach to your score. If we're working on your credit, we're not just looking at the score. And sometimes people lose sight, or they're so short-sighted or so fixated on the score, and they're like, yeah, the score is but look, your credit profile is looking better. We cleaned up this, and now you had a account that had a late payment. Now it's updated to a more positive status. That looks good. We're able to get these inquiries, so now you're not looking as though you're big and always asking for money. That looks good. You open up a new account that positions you to reestablish some new positivity going on in this area that's going to benefit you because you didn't have it prior to. So now as the months progress, you're able to have a more solid profile, and the negativity gets overshadowed by the positivity that you're incorporating on your credit profile. That's good. And oh yeah, we were able to get some things deleted as well. That looks good. So it's a holistic approach that has to be taken on your credit. If anybody is only talking about deletions and not talking about the whole score, then they may be doing you a disservice. So it's important for you to understand these nuances because regardless of how they make a certain change, a person's credibility matters. See, a credit profile is just your reputation. That's just them being able to view you as an individual and how you handle certain agreements that you signed into. And this is no different than how you may be a person who judges people. You're not going to let somebody who you know is just always coming with their hands out and not likely to keep their word, or they're likely to get over on people. You're not going to let them keep coming around you and your family. Not if you're smart anyway. Eventually you'll get the memo and say, okay, I know where they at. I know what type of time they on. Let me go ahead and disassociate with this person or not, do what I've once done based on them showing their credibility or lack thereof. The same is true with a credit report. So if you understand it with people, then you should understand it in this category. So understanding that puts you in a better position to understand, okay, I get it. Now, we're not here to say that it's things that you can't do based on previous errors you may have made that can get your thing cleaned up, because when it comes to certain laws that govern the credit industry, you're looking at the FCRA, the Fair Credit Reporting Act, which means that if they're not reporting it appropriately, then a lot of those things are supposed to be removed. That said, there are some times you can benefit from that FCRA code, even if you were the person who defaulted or had some type of hiccup. So that is still to your benefit, but still always have a good character, good moral compass that positions you to understand that overall you want to have the report that reflects a person who has a level of credibility. Let's dive in a little deeper, shall we? So it says our underwriting standards are the same. And basically they said as a process matter to ensure two scores can be used and not just one. We eliminated requirement for the FICO in the infamous guide. Big deal for consumers, small or nothing deal for underwriting. So they're saying it's not a big deal for underwriting, but it's a big deal for consumers because consumers are able to go in there and get approved because it's not solely based on the score. It said instead of relying on a hard credit score cutoff, the DU system will now evaluate a broader set of credit risk factors, including the borrower's credit history, income, debt levels, property characteristics, and loan purpose. Let's break that down because this is what I was talking about. So they said, number one, the risk factors that they're looking at, because they're still looking to see if you're high risk. Let's be clear. And it says, including a borrower's credit history. Like what historically have you done that represents what type of borrower you may be? Do you have some cards that you've paid off, loans that you paid off in full? Even though you might have had some hiccups here and there, have you showed a track record of success when it comes to things that you paid on? Okay, we get points for that. Income. Are you keeping a certain income? And if so, is it a steady income? And for how long? Okay, you get points for that. What are your debt levels, aka debt to income ratio? How much debt do you have in comparison to your income? And are you spreading yourself too thin? That's what they're looking at. You get points for that. So when we say, hey, set a goal to lower your credit utilization on these cards, these balances, all of these things are helping your score, but more importantly, helping your profile if you aspire to own a home. Very important. And then property characteristics. So the home that you're going to be buying, they want to know the characteristics of the home because they want to make sure that you're going to still want to live in that home years down the line after they've already provided the loan. So if the property characteristics are of a home that doesn't check out the boxes in their opinion, then that alone may not allow you to get qualified for the mortgage. And if so, it may not be on the terms that you prefer. However, if the home has something that represents, oh, okay, it's some value here. Oh, it's some potential in this area. Oh, it's some potential in this property as a whole based on the things that are happening around it. Oh, we can get behind that. And what I strongly suggest is doing it how we did it when it comes to buying a home. You buy a home with equity already in it. And the best way to do that is to buy a home off market. Yes, you're going to have people who are selling you homes at the market value, whether it's a realtor, whether it's, online platforms, because the game is changing. But what you want to do is make sure that you buy the home on your terms. And the best way to do that is off market, because now you can position yourself to buy it with equity already in it. That's a whole nother masterclass. And then they talk about the loan purpose. So when they say loan purpose, they're more than likely looking at it is this person planning to live in it, or are they just trying to flip it, so to speak, or use it as an asset? And I'm pretty sure the person who's trying to live in it is more likely to get these approvals, because if you're trying to live in it, then you're someone who is directly impacted by keeping this mortgage and staying in this home and making sure that the mortgage is paid versus you just trying to flip it. And you don't really care like that because it's not your primary resident. So they want it to be your primary resident, I'm sure. I'm pretty sure. And if things change, I'll let you know. But I'm pretty sure that's what it's going to be based on. What is the purpose of the loan? Because they want to make sure it's tied to you and they have all of the boxes checked that minimize the risk. The DU risk assessment reflects a comprehensive evaluation of credit risk factors from the borrower's credit report, along with non-credit risk factors from the loan application. I cover some of those if you understood what I just broke down. Then it says the minimum representative score requirement of 620 will be removed for new loan case files created on or after November the 16th, 2025. This requirement will be replaced with the minimum credit risk standard based on the credit risk factor evaluation within the DU credit risk assessment. So it's going to be replaced with whatever the minimum credit risk standard is. It may not be a number, but in their system, it is some type of valuation. And then it says Fannie Mae moves follow Freddie Mac, which previously eliminated its own minimum score for loan approvals. However, Fannie Mae clarified that lenders must still request credit scores for all borrowers as required by loan sales, and certain loan types or private mortgage insurers may continue to impose their own minimums. So this is not to get away from the credit score altogether. Yes, you still need to make sure you do things that makes your profile look good. Yes, you should still seek assistance and guidance. And of course, if you want access to that, we got things down below that can help you hit those goals. So yes, you should still care about your credit profile, which automatically converts into your credit score. But just keep in mind what's going on and how the score is being removed, but they still look at some type of credit risk factor. And it says the update also expands Fannie Mae's Day One Certainty Program, offering lenders relief from enforcement of representation and warranties for certain undisclosed non-mortgage liabilities. Additionally, documentation and homebuyer education requirements for borrowers without traditional credit will now be triggered only when no borrower has at least one credit or installment account reported. So if you don't have some type of credit or installment account reported, then they may have to incorporate some type of home buyer education requirements. And they do this with different programs like NACA, et cetera, that positions people to learn a little bit more. So you can say, hey, you can't say you didn't know certain things because they taking you through a curriculum that proves that you did. Then it says the changes come as the mortgage sector faces ongoing debates about the relevance of credit scores and risk assessment, because the credit scores are being challenged, the credit bureaus are being challenged, all of these entities are being challenged. So people are wondering if things should continue business as usual or should we make some tweaks? And that's where these things come from. So hopefully you understand a little bit more about what it means when they remove the score. Does that remove all responsibility? Absolutely not. Does that mean anybody can go in there and qualify just because the credit score is starting to be less of a factor? Absolutely not. Does that mean you should not continue to focus on bettering your credit profile as a whole? Absolutely not. But you should make sure that you understand what's going on, so when they market it in a certain way, you have a better perspective of how to view it and how to position yourself to benefit from it or stay away from it. The choice is yours. If you need assistance with taking your credit to the next level, links down below. You know what to do. Do what you know. Salute.